Hey everybody, Mike DeSapoli. Welcome to the Heritage Special Market Update for Monday, January 24th, 2022. We hope you're all doing well. Had a great weekend. A wild day in the markets today. We want to talk with you about this. We know that the fear in this market is palpable right now. We understand the perspective of investors that this has been a very difficult period here, to own stocks and hold stocks through, seeming like the end is near and there's never going to be good times in the market again. We know the feeling. We understand it very well. We've been through many of these corrections. They all start the same way. You never see it coming. And when you're right in the teeth of it, it feels like it'll never end. But we're hoping today to convey some of our wisdom and knowledge here with you and fight fear with facts and show you some of the data that supports that there's many good days ahead for this market, even though it may not feel like it right now. So first, just let's take a look generally. What did we see today? This is not the type of market activity that you will see every day or see many times through an investor's lifetime. But we saw the markets open down in a big way this morning, down by more than 4%, and then stage a massive rally off the lows, off of what appears to us to be capitulation lows, a selling climax. Because again, folks, to see the Dow Jones, let's take a look at our indexes here. At one point today, the Dow Jones was down 1,200 points, finishing positive by 99 points. We saw the NASDAQ down about 600 and change or so points here today, finishing positive by 86 points. And the proof is across the tape here. You know, it's not abnormal to see a market negative finish positive or a market that's positive finish negative, but to see it in these types of extreme levels, usually the type of activity that you see around a bottom. Now, again, one day doesn't make a trend. It's going to take some couple days here, maybe a week to confirm if this type of constructive activity that we see has staying power in the market. But again, we want to share the data and the facts with you to support our belief as to why what we have seen recently is heartburn and not a heart attack. So let's go through some of the data. The first thing that we need to talk about and we need to understand in the markets is that corrections are a feature of markets and not a malfunction in the markets. And particularly the type of correction, the narrative around this correction that we're seeing right now, it is entirely Fed induced. Fed policy, Fed speak, Fed jawboning. And I wanted to highlight just since 2009, the corrections that we've seen in the market and how many of them have been induced by the very same narratives and headlines that we are dealing with today, right? So the first correction listed, highlighted in the blue, is the current correction that we're going through. This suggests it's January 4th through January 21st. I think it's been a little bit more broadly than that, probably the last 2 to 3 months. And why are stocks falling? Quote unquote, inflation fears, rising rates, and tightening of Fed policy. Well, folks, if we look through this list here, and I've excuse my poor job of highlighting, but you'll get the point, is how many times have we seen the market correct over the very same concerns of Fed taper fears, rising rates, inflation fears, and the likes, right? Several times listed here on the list. How many times has the Fed raised rates over the past 10 years, right? Well, albeit up, aside from a short period in 2018 where we saw 8 rate hikes, we saw one previous to that in the period around 2015. So the point I'm trying to convey is while the Fed does a lot of talking, while the Fed does a lot of barking, they tend to not do a lot of biting. But the market takes some time to figure out those facts. Now, each one of the corrections listed on this list, and we realize they are varying in size, some as low as small as 5%, some as deep as 35%, and also varying degrees of durability and duration, right? We saw some of them last as short as 11 days, others lasted a couple months. But the point that we're trying to convey here is that every one of these previous corrections was followed by all-time highs in the market. Now, you could argue, well, Mike, I hear it all day, folks. This time is different. This one is different. The conditions around this one are different. The macroeconomic conditions that are adding to this or fueling the fire are different. And maybe you'll be right, and maybe this will be the correction that takes the markets down to zero, but I highly doubt it. And if history is a guide, we will see all-time highs in this market yet again. Now, when you have this type of Fed-induced fear in the market, it tends to be resolved when we get some clarity around Fed policy. So Jay Powell, the Fed chair, will have an opportunity this week on Wednesday to soothe the markets, to calm the markets, and to recalibrate the message that the Fed is sending to the markets. Because if you don't think the Fed is paying very close attention to the developments in the equity markets recently, they certainly are. So I think that that's something that remains to be seen, how Jay Powell will respond on Wednesday. But we think that the stage is already set for the expectations around the Fed and interest rate increases to shift. Now, another thing I wanted to share with you here today is looking at some resources, okay? We got to put these different moves in the market in perspective, right? Every correction feels the same way. It comes out of nowhere. When you're in the middle of it, it feels like there's no breaks to it, and it feels like it's never ending. And they all end, and they will all resolve themselves like they always do. But sometimes it's not till we get out of the thick of it that we realize that not only was this a correction, that the market was essentially cleansing itself to prepare for a move to new highs, but that these were fantastic buying opportunities. But the thing in markets, when things go on sale, nobody wants to buy anything. And the times that you should buy, the times that we should be buyers are generally, the times when we don't want to, right? So just looking at the index since 2008, since the great financial crisis and recession that followed that, the market is always climbing the wall of worry. And hopefully you folks can see this on the screen here. I know some of the writing is a little bit small, but these are listing all the different problems, perceivably problems, that the government, that the markets have gone through, that we as a country have gone through just since 2008, right? Too many problems, if you will, to even fit on a single slide. But the point here is that the resolve of markets takes markets higher. Markets love to climb the wall of worry. And each time that one of these singular events reared its ugly head, we heard the same thing from investors and pundits on TV, that this is going to be the straw that breaks the camel's back. This is going to be the end of the good times in the market. And if you look, the proof is there. The market has continued in the face of adversity and problems to climb itself higher and higher. And the average return of the period shown below was just over 11%. So not paltry by any means, and something that I think many investors would sign up for. But again, while you're in the middle of these corrections, they tend to feel like they're everlasting. Another thing we want to show you that is declines in the market, intra-year calendar declines are normal. They're never going to be fun. You're never going to enjoy them. But this is part and factored into every investment strategy. Now, it's important to remember, when you own investments that are declining, it, number one, does not mean that you have a bad investment strategy. And number two, it does not mean that you own bad investments. Sometimes the market has a way of discounting everything at the same time, and good investments get swept up in the currents and they get thrown out, like throwing out the baby with the bathwater. We think that is the case here. There's a lot of high quality investments that have trended down recently in this market with really no justifiable means as to why that has happened. But when the mood and the sentiment in the market shifts to a risk-off type of sentiment, people are selling first and they're asking questions later. And eventually, that will shift back to a risk-on sentiment where people will be buying hand over fist and they will chase this rally higher. Now, if you look at intra-year declines in the market, it is very normal on a calendar year basis to see declines in the market. And it's actually very normal to see double-digit declines off of all-time highs in the market. If you look at this graph here, this is going back to 1980, and you can look at the numbers for yourself. You see that we have periods in the market where we've seen 17, 18, 13, 20% declines, 34% declines, 49% declines. Obviously, that little bit of an outlier there, that's the Great Recession. But even just look over the last couple of years, we've lived through 12%, 11%, 20%, 34%, and here we are going through it yet again. Markets are down, give or take 15% from their all-time highs, and everybody is running around screaming like their hair's on fire. Okay, we understand the emotions that go along with this. It's not fun to lose money, but again, if you own quality investments, and we have a ton of conviction about the investments we own, about why we own them, why we should continue to own them, and why these investments are going to pay out handsome returns and dividends over the long run. But it can be very difficult to maintain that conviction during some of these periods of times where emotions are running high, the market seems like it cannot find a bottom, and it starts to feed the prophecy of fear, fuels itself, and it can spiral out and move down in a very sharp way. Now, what we saw today in the market is a very important thing to note, okay? Again, we have to see if we get some follow through. but usually corrections end with a strong flush down, a selling climax, and a capitulation of fear. And we saw the fear gauge today hit levels that we have not seen since March of 2020. Now, I don't know about you guys, but I don't see the problems here and now in this economy that we had on our hands back in March of 2020 when the whole world was shutting down, where some people didn't know where their next paycheck was coming from. Governments were doing large-scale lockdowns, shutting down private businesses. Air travel was screeched to a halt. So I don't think that we should have the same levels of fear that we have today as we did in March of 2020. But nonetheless, that is what we're seeing in the market. And this is what is being brought upon by a lot of new investors that came into the market March and April of 2020. And for 18 months, they have never seen a correction. They don't even know what a correction is until they were right in the teeth of it. And it was hitting their portfolio hard. And it's leaving a lot of people without direction and knowing what to do. And that type of thoughtless selling is what contributes to these declines. So this is why when we have high conviction about what we own, why we own it, and where it's going, we will hold strong through these declines. We will weather these declines if and when, and in this case we certainly do, believe that there are better days ahead, there are all-time highs ahead. And when the market gets this oversold and we see this level of irrationality flowing through the market, we refuse to participate in it. We refuse to buy the head fake that we believe that this is, and we strongly and firmly believe that this is a head fake. This is not the end of all days in the market. Right now, the market is going through a phase where it is adjusting to the nuances from the Fed and to some perceived changes in Fed policy. But again, it's important to keep perspective. Interest rates going from 0 to 0.5% or 0 to 1% is not a catastrophic increase in interest rates. Many of you remember back in the early 80s, interest rates were 16, 18, 20%. And look back to how the market did during that period of time. Markets did very well for that period of 5 or 6 years after the Fed significantly raised interest rates when that was supposedly the last time that they lost control of inflation. So what we expect to see over the coming days, over the coming weeks, months, etc., is that investors will realize that this market is wildly oversold. There's a ton of opportunities littered throughout this market. You don't have to look far and wide to find them. There are many good quality companies on sale. And as the Fed takes the podium this week and in subsequent meetings, we believe that their terminology and the Fed speak will shift in a way where investors will get the message that the Fed is not on some preset collision course to raise rates 5 or 6 or 7 or 8 times, or however many absurd times we're hearing the financial media suggest is the case. Now, yeah, geopolitically, the Russia-Ukraine situation impacted markets a little bit today. Again, if you look at some of the data that we shared, there's always geopolitical events that go on. Again, this is not our first rodeo. We've been through many of these. I remember, going back 6 or 7 years, Greece and the debt burden that they had were supposed to implode the markets. Then Cyprus was supposed to drag the markets under. Then Italy had a debt contagion in their bond market that was supposed to drag the market under. And then fast forward, there's so many events, folks, that were supposed to be the end of all the good days in the market. And again, maybe this time is different. Maybe this is the one that's going to put the U.S. out of business, but I wouldn't bet on it. And I'll take the other side of that bet. We think this market is going higher in a meaningful way. It is just in terms of what we need to do right now, we need to have the resolve to get through this, to remain calm, to invest on, and to allow these investment opportunities that we see in this market to take shape. We will be buyers of this dip once we can confirm that the bottom is in and the market does start moving higher. There is a litany of stocks that we want to buy right now. We think the shopping list is long, and when the market throws a sale, it is right for us to take advantage of these opportunities. So if you folks have any questions, please reach out to us. We know these are stressful times. We know these are trying times for investors. The emotions that go along with these type of declines in the market, like we always say, the gains never feel as good as the losses feel bad. We understand that. That's a general consensus amongst all investors. But there will be good days ahead. We will get through this. It's not our first rodeo, so just keep calm, invest on. If you have any questions, please reach out to us. Don't stew on this stuff at home. We know that it can drive you crazy. reach out to us. We want to talk with you about it. We want to get you through it, and we certainly will get you through it to the other side and better days ahead. We hope you have a great evening, and reach out to us if you have any questions. Have a good night. We'll see you back Friday for the Heritage Market Pulse.